What if I already have a high school student or a college student and I don't have one of these plans in place? Is it too late? No, it is not too late. You just need to add one more element to this, okay? For example, earlier in this video, I talked about how this was the biggest college savings plan, works for any student, any school, okay? Doesn't require scholarships or financial aid, younger students, older students, and it can be used to pay for college, or, and here's the key, it can also be used to pay back college loans. So if you have a high school student or a college student and you don't have one of these plans in place yet, then what you'll do is you'll use, number one, you'll start with college loans to pay for college. So step one, use college loans to pay for your next semester's bill. Step two, start saving right away into this insurance plan. Then step three, use the insurance loans to pay back the college loans after graduation, because your college loans can be deferred on the payments. The payments can be deferred for 6 months after graduation. So you don't have to make any payments on the college loans. You can make all of your payments here, okay? Make all of your contributions here into the insurance plan, then use the insurance loans to pay off the college loans, okay? So again, maybe over the next 5, 10 years, 15 years, you start saving money. Okay? Then after graduation, you take out loans for 10 years or 5 years or 15 years, and you pay back the original college loans. That's how you do it if you have a high school student or a college student. It is not too late. Okay? Now, what if the college loan rate is higher than the 6 to 8% interest that the IUL can earn? Well, there's a difference between compounding interest and a decreasing interest. This is compounding interest. If you don't make any payments on these loans, those loans are compounding. Your money is compounding. It's the difference between those two of 1% that gives you that full refund off the cost of college. If you have college loans, that interest on that college loan, even if it was at 8%, even if you had a higher interest college loan, that interest is going down every year because the loans are getting paid off. How are they getting paid off? They're getting paid off by taking loans at 5% over here and using that money to pay those off. So you could pay those off in one shot. You could pay them off over 5 years, over 10 years, over 15 years. It all depends on how much money you have saved into this plan, okay? But either way, this interest is actually decreasing. Let me show you the actual numbers. Here we have a $100,000 loan at 8%. This could be a college loan at 8%. And we're making our monthly payments of, let's say, $1,200 a month, $1,250 a month, right? Look at the interest. The interest is going down because your balance is going down. Yes, it's 8% interest, but it's 8% interest on a smaller number every year. So it's a decreasing interest because your balance is decreasing. So yes, this will still work even if the college loans are costing you higher interest than what you might earn on the IUL. Now, there are a million reasons why you don't want to take out college loans, but let's talk about why you may want to use federal college loans to pay for college. Now, I know this is going to throw you off a little bit because everyone wants to avoid taking out college loans. But let me show you something. I'm going to give you a little sneak peek of secret number 2, which is how to reduce the college loans and the college loan payments, okay? Now, I have another video that dives into that in a lot more detail, but let's just give you a little sneak peek on the secret of using college loans. And the secret is loan interest rates are not the most important consideration. Everyone, when they go to take out college loans, the first thing they look at is the interest rate on the loan. That is not the most important consideration. Using college loans strategically could save you some of the most money off the cost of college. It's a huge, huge savings. That's why I recommend not using your 529 accounts, your savings accounts, your retirement accounts, even your whole life insurance or your cash flow to pay for college. I recommend using the federal loans to pay for college, and I'll explain why. Now the kids can only get a minimal amount of either subsidized or unsubsidized Stafford loans. $5,500 the first year, $6,500 the second year, and $7,500 the last 2 years. And in a 4-year degree, that's $27,000. If they go on to 5 years or 6 years, they can keep borrowing $7,500. If they go into graduate school, they can borrow an unlimited amount for graduate school, but for an undergrad, only $27,000. But the parents can borrow the difference from the government and federal loans. Now, even if you make too much money to qualify for any sort of financial aid through the FAFSA, and even if you don't make any money at all. Now, think about this for a minute. Yes, it's true. The government will loan you money if you can fog a mirror. If you have like a basic low credit score and you don't have any like student loans that you've defaulted on yourself, you can borrow the money to pay for your kids' college even if you don't make any money yourself. I'm not saying I agree with it. I don't think it's necessarily right, but it is what the government is doing to solve the problem with the high cost of college. It's called income-driven repayment plans. If you don't know what an income-driven repayment plan is, this could be your lucky day. The loan payments are a percentage of the income of the parent, not the parents, that takes out the loans and not the loan balance. Think about that for a minute. I'm going to say it again. The loan payments are a percentage of the income of the individual parent that takes out the loans, not the parents. You could have 5 kids go to Ivy League schools and borrow $1 million from the government. Now, why would the government loan you $1 million to send 5 kids to school if you have no income? I don't know. I have no idea why they are doing this, but this is how they're solving the problem of the high cost of college. Take out the loans on the parent that makes the lowest income, even if they don't have any income at all. It's not about the interest rate on the loans. Go out to studentaid.gov and look it up. On studentaid.gov, just do a search for income-driven repayment plans, and it says right here, if your loan payments are high compared to your income, you may want to repay your loans under an income-driven repayment plan. Here are some of the income-driven repayment plans. Let's take a look at them a little bit closer, okay? We have the income contingent repayment plan, or ICR, which is 20% of your discretionary income for 25 years. We have the income-based repayment plan, IBR, 15% of discretionary income for 25 years. We have the pay-as-you-earn payment plan, pay, 10% of discretionary income for 20 years. And revised pay-as-you-earn repayment plan, or repay, which is 10% of your discretionary income for 25 years. And they're coming out with new ones all the time. And if you're on one of these payment plans and you work for a nonprofit organization, then you get public service loan forgiveness, or PSLF, where it's only 10% of your discretionary income for 10 years, or technically 120 payments. But nonetheless, these are huge discounts off the cost of college. So do the math. What is 10% for 20 years of the parent that makes the least amount of money? I've got 2 kids in college. My wife makes no income. She has no traditional income. We are taking out the loans for both of my daughters that are in college without any income. She's never had an ounce of problems qualifying for these loans, and the money gets sent to the school within about 45 or 48 hours, okay? It's crazy. Now, I'm not saying I agree with any of this. I'm just saying these are the plans that the government has in place. It's completely ethical. It's completely legal. This is their solution. We call it an education tax that they're basically coming up with. Another reason why I don't recommend using your 529 accounts or cash flow to pay for college. I strongly recommend rolling the dice a little bit, starting with these federal loans and seeing what happens. See if you could benefit from one of these plans. You can always refinance these to a private loan at a lower interest rate, or just pay them off if you want to, if you can. Okay? So again, step one, I highly recommend using the federal loans to pay for college. Even if you don't have to, even if you could pay cash, I highly recommend using the federal loans to pay for college. Then save as much money as you can into the insurance plan. Then use the loans from the insurance company to pay back the federal loans later, or refinance these loans, or still you could refinance these loans and still use the insurance loans to pay them off, whatever the case may be. But think about that as a strategy that could save you a lot of money. Now, caution and disclaimer. You are dealing with the federal government. These are federal loan programs, okay? These programs could change and probably have since the time I recorded this video, okay? Consult with a certified student loan professional. Yes, believe it or not, there is a certification called a certified student loan professional that will help you navigate these different income contingent repayment plans. And most importantly, plan for the worst and hope for the best. I strongly recommend using this retirement scholarship strategy to be able to pay all of the cost of college back, but add these college federal loans as a way that could potentially save you a lot of money. And then if you didn't need to use all this money to pay back your federal loans, you could use it for retirement or something else. So let's review all the benefits of the retirement scholarship strategy. Competitive return. Yes, it's possible to get over a 6% average return. Doesn't negatively affect your EFC or SAI number. I go into this in more detail in the video on secret number 1, which is how to maximize the free money from the schools. But part of maximizing the free money from the schools is to not show that you have a lot of money that can be used to pay for college. It's that simple. So if you have money in one of these insurance plans, it does not hurt your EFC or SAI number, okay? Low fees if set up correctly. Tax-deferred growth on the money, okay? And tax-free access to the money through the loans. They don't tax loans, okay? Guaranteed loan approval. No credit check, no application process, guaranteed loan approval. Fixed loans, not variable loans. Some insurance companies have variable loans. Make sure you get a fixed loan that won't go up on you or the whole plan could go south, right? High contribution limits. You can invest or save into this plan as much as you want to a certain extent. Flexible contributions. Maybe you have a bad month. Maybe you have a bad year. I had a phone call today from a client that needed to put their payments on hold for a while. You can put your payments on hold. Flexible payments into these plans. And of course, you have access to the money.